Welcome to this week's episode. I'm very fortunate to have a special guest, Steven Jarvis. Steven is a CPA and is also the host of Retirement Tax Services podcast. Welcome, Steven.
Ryan, thanks so much for having me on the show. I'm excited to be here.
Yeah, me too. So we were talking earlier about how we could really add a lot of value to the listeners this week, and we're going to tackle in this episode. You're fresh off, as you said, tax season, just got done cranking out a bunch of returns. Some of the biggest mistakes and issues that you've seen this year, and some suggestions of how folks can try to avoid those things happening for this upcoming year.
Yeah, and just so people listening maybe put a little bit of faith in what I'm talking about. Just a little bit of background. I've been a CPA. Well, I've been in this world for actually just about 14 years. My daughter was born the year I joined the industry, so it's easier for me to keep track. And I work. I work directly with hundreds of taxpayers. At this point, I've worked on thousands of tax returns, and thankfully for me, they're all fairly focused. So the tax code's 80,000 pages long. So if anybody listening to this feels overwhelmed by taxes, that's completely understandable. It's this giant black box of a mystery that very few can navigate. And so I've been fortunate to stay pretty narrowly focused. So I've got a lot of reps doing kind of the same thing over and over, which is helping people who I work with a variety of people, but all individuals and families. I don't do a lot of business tax work. I work with people who have a long-term focus. So it's balancing getting the tax reporting done correctly as well as having that eye for the future. Because as we talk about mistakes that people make on tax returns, the one I usually start with is that a lot of people make the mistake of assuming that there's nothing they can do to affect the outcome of their tax return. And what I mean by that is we're sitting here in May of 2024.
Yeah.
So hopefully people listening have already filed their tax return for 2023.
Or an extension.
Maybe they're on they're on extension, so it could still be relevant. But for the most part, 2023 is over. Like, we can't go back and now do tax planning retroactively. We have to be looking to the future. And so we kind of get caught in this trap of trying to figure out what we need to file for last year. And then it can feel daunting to turn around and think about what we should do for next year. So the first kind of myth or mistake that I try to get people past is that there are choices that we can make on taxes, and there are things we can proactively do to make sure that we sand off the rough edges of our lifetime tax bill. Because I am all for paying the taxes we owe, but there's no patriotic rewards for leaving a tip to the IRS.
Sure. I think I heard you say that a while ago. I've stolen that phrase from you before, but I like
Please
that.
Do.
Pay your fair share, don't leave a tip, right?
Yeah, I'll have to give credit. Originally, so it's kind of my own version of something that comes. I'll have to learn more about him, but it was a judge decades ago. His name was Learned Hand, Judge Learned Hand. Okay. He had a famous quote about how none of us, there's no patriotism in overpaying. So anyway, so that's from a high level, that's usually where I start. But some specific things that came out of this last tax filing season, I had quite a few questions from people around some things that they were surprised to see on their tax return. And you might have listeners who are in this same boat where there's these amounts on their tax return that they've just never had someone to ask or never sure what to do about it. And one of them that comes up pretty often, it's usually not a big dollar amount, but it just kind of cuts out some of the confusion, is the foreign tax credit. And quite often, if you have a diversified investment portfolio, which I'm not the investment guy, so I am very generically using that term. Please don't ask me for investment advice. That's not my thing. I stick to taxes. But quite often what I'll see with taxpayers who are working with an investment advisor or who have some kind of diversified portfolio, there will be international components to that, and they may not even realize it because they aren't going out and buying ownership in the country of Sweden. I'm not sure you can do that. They're not necessarily even going and buying ownership in a Swiss company. Well, I guess Swedish would be from Sweden, but again, tax guy here. But a lot of times these different ETFs, these different mutual funds that people will buy will have some kind of international component. And Ryan, you could probably speak to that more.
Yeah.
But what will happen is that these investments create foreign tax obligations, and then the U.S. tax code gives a credit for what we've paid to a foreign country. So that's one of those areas where this foreign tax credit will then show up on the tax return on Form 1116 for any tax nerds listening, that we get a credit against our U.S. tax liability for what we've paid to a foreign country. So I had a couple of people this year, they'll come up once or twice every year, who will have this moment of concern that they've noticed for the first time that they have a foreign tax credit, and they'll say, well, hold on a second, I'm not doing any international business. What is going on here?
Yeah. Yeah, I mean, there's a lot of, you don't always know what's going on in your mutual fund or your ETF. Yeah, until you get your tax return done, right? So
until you get your tax return. So that for a lot of the taxpayers I work with, and probably for a lot of your listeners, that's a relatively smaller amount. Some bigger dollar amounts that I start to see, especially as people are nearing and getting into their first few years of retirement, where we start seeing that these things can really have a much bigger impact. Is when we start talking about rollovers from 401ks to IRAs, and when we also start looking at equity compensation and severance pay. So maybe some of these things that are larger one-time events.
Sure.
That for your listeners, they might only go through this once in their life, right? For most people individually, they might roll over a 401k once in their entire life, maybe twice if they had more than one employer, or maybe 2 or 3 times if both spouses have a 401k. And in theory, this should be relatively simple. There's some paperwork involved, again, that you could speak more to, but the idea is that we're moving this 401k to an IRA. This might be because we left our employer. It might be because it gives us greater flexibility. There could be a variety of reasons.
Sure.
And in theory, this should go very simply. The money goes directly from a 401k to an IRA, and there's no tax event. But I often enough see mistakes happen here that it's worth talking about, that we want to make sure we're paying special attention in the year that happens, that rollover is in fact treated as a non-taxable event. And the tax reporting form, it's called a 1099-R, that tells us about this rollover. It's not the best form that's ever been invented. It can create some confusion. It can create some headaches. There can be mistakes on it. And so this is why I always pay special attention in years where we have transitions, rollovers being one of those, that we want to make sure that all this hard-earned money that we've saved up and put in a 401k that's grown tax deferred, we don't want to suddenly pay taxes on that all at once. So when we look at our tax return that year, we're going to see the rollover. It's going to be on line 5A. I am enough of a nerd that I know exactly which line some of these things come through on. It's going to be on line 5A, which is listed as pensions and annuities. That's where the IRS puts 401ks as well. But it shouldn't be on line 5B, which is our taxable amount. And so we want to make sure that when we have those transition years, we're paying special attention to make sure that we're not getting hit for amounts we shouldn't be taxed on.
And correct me if I'm wrong, but usually also, like just to the left of the amount, it says rollover as well. It's like typed in there, right?
Yeah, quite often it will. Yeah, you're very astute to point that out. Quite often it will say rollover, and honestly, it looks like it's kind of like in the margin, like someone got out an actual typewriter and like forced it in there. But no, that's how the IRS set it up. There's some things on the tax code, on the tax returns, that don't really make a lot of sense, and that's one of them. But it should, in big bold letters, say rollover.
Yeah, you would think there'd be another line that would say like rollover or like a box to check, but it looks like you said, like somebody took your tax return and typed it in. And I always, I try to review my clients' tax returns as well, not to file them, but just to make sure like things like this don't, go by the wayside. And every time I see like a large amount, especially for a prospective client too, I often will then look to see, does it say rollover next to it? Because if it said like somebody had a $650,000 IRA distribution, I would hope that would have been intentional or not, a mistake.
Yeah, one of the things I try, as we talk about mistakes that come up with tax returns, I try to remind people that when we have taxable events or tax-related events, tax-adjacent events, whatever you want to call them, this isn't we don't get to just think about this once. We need to think about this a few times. And so if we stay on rollovers, this we'll call this a tax-adjacent event because it goes on the tax return, but you shouldn't be paying taxes on it when it happens. But we need to think about the taxes when we initiate the rollover. We need to think about the taxes if we're working with a tax professional, we need to make sure we're communicating that to our tax professional that, hey, I did a rollover this year. That's what that tax form is going to be related to. And then ideally before our tax return is filed, when it's still in a draft form, we're taking a look at it again and saying, okay, did my income change this year and should it have? And so if I was expecting, I had the same job, was making the same salary, got a similar bonus, and I take a look at my 2023 tax return and all of a sudden it's $500,000 higher, wait a second, we need to go back and double check that rollover got reported correctly.
Definitely. I've had, over my career, a few clients reported incorrectly. And then usually they get I don't know what you call it, the nasty letter from the IRS that they owe tax on, a big amount they didn't know about, and then they got to correct it. But it's obviously a lot easier to do it properly the first time before you file.
Yes, we definitely prefer to do things right the first time. We do have a couple-year window where we can go back and amend returns and correct things, but ideally we're doing it the first time and just avoiding all of that headache. As we talk about transitions, I mentioned a couple of things, other things in there, like equity compensation and severance pay. And in contrast to the 401k, where when we do that rollover, we're expecting it to not be taxable. Sometimes I don't know that you should be happy, but at least understand that, hey, earning more income, a natural side effect of that is that you're going to pay higher taxes. But what we don't want to do is inadvertently pay tax twice on things we shouldn't have to. And equity comp is a prime example of that, whether it's non-qualified stock options or restricted stock units. I'm throwing around a bunch of different terms here.
Sure.
That for a lot of your listeners, only the ones they've been exposed to are going to sound relevant, and I wouldn't spend your weekends researching the other ones. But unfortunately, what will happen here is that a lot of equity-based compensation actually gets taxed through your W-2. So your employer is handling a piece of the tax, the tax bill, the tax liability. What will happen though is that now we have our employer reporting a taxable event when the equity compensation is vested, is typically when that comes through.
Yeah.
But then we'll also have the investment custodian who holds those equity positions report activity for the year as well. And way more often than I'd like to see, we see issues where it gets reported as taxable by both parties and we pay taxes twice. In fact, some of the largest amendments I've ever done from the standpoint of refunds I've requested for clients that are new to working with me is going back and correcting this issue where equity compensation got double reported. And that's one of those areas that I am all for people DIY. Yes, I'm all for people DIYing. There are things I DIY in my own life, but anytime you're a DIYer in any area of your life, you need to know that there's a line where you should probably go and ask for professional help.
Sure.
And it's a little bit different for everyone, but for most people, if equity compensation's involved, that's one of those areas where I say, hey, it's time to go and just ask someone to look this over, double check this.
Yeah, I mean, there's certainly, if you have a standard return, right, one W-2 or one 1099, like, you could probably easily do your return yourself, but the more moving parts, you really need a professional.
Yeah, absolutely. Yeah, and that gets into some of the other things that I typically see where, thankfully, I get to work really closely with taxpayers and we get to catch these things before they're mistakes that need to be amended. But certainly where I see people have questions or confusion will be around advanced charitable giving strategies like donor advised funds, or even qualified charitable distributions, bunching our charitable giving, whatever it might be. Because Ryan, as I'm sure you're familiar, about 90% of taxpayers at this point take the standard deduction, which means that things that historically we all thought of as, oh, I get a tax benefit for that, like mortgage interest or donating to the local charity that I support. A lot of people will still have it in their mind that, oh, I get a tax benefit for that. And the reality is for 90% of taxpayers, there is no tax benefit unless we're being intentional about using one of these other strategies to make sure we get a tax benefit.
Yeah, so you mentioned qualified charitable distribution. Just tell the listeners again. I've talked about that before, but what is that again?
Yeah, qualified charitable distribution, or a QCD. This is an opportunity to make a charitable contribution directly from an IRA to a charity that we support. And I keep making that comment about charities that we support or that we care about or that are in our community, because even though I'm the tax guy, I I remind people all the time that we need to make good life decisions and then figure out the most tax efficient way to do them. Because best case scenario from a tax standpoint, we're going to donate $1,000 to charity and then we're going to get a deduction related to that. So we might save $200 or $300 in taxes.
Sure.
So if it's a charity we care about, great. That just gives us even more ability to support that charity. If you weren't already charitably inclined, spending $1,000 to save $300 never works out. And if you'd like to do that, you can send me $1,000. I'll send you $300 back every day of the week. That'll be my new job. But
so that's how you got those medals.
That's how I got all the medals.
There's a lot of medals behind them if you can't see.
So we want to start with good life decisions. So we want organizations we care about. So these qualified charitable distributions. Another mistake I point out for people is when they try to find logic in the tax code. There is no logic in the tax code. We just have to understand the rules available to us and make good choices where we can. And charitable giving is one of these. So the IRS decided, or Congress decided at some point, the IRS wrote the rules that taxpayers should have this option to give directly from an IRA. And it used to be tied to the age where required minimum distributions kicked in, but that age keeps getting increased. And thankfully, the age for QCDs has not changed. So at 70 and a half, we are eligible to give to make these qualified charitable distributions, which have a couple of advantages. One is that we no longer have to worry about whether or not we are giving more than the standard deduction. This is completely separate from itemizing our deductions, and we can get a tax benefit even if we're not itemizing.
Sure.
Another big advantage is, of course, you're familiar with Ryan, but for your listeners, is that this qualified charitable distribution comes out of our income before adjusted gross income, which is important because as we get to Medicare age, that adjusted gross income number goes into figuring out how much we are going to pay for Medicare. And so there's additional benefits to being able to do a qualified charitable distribution, or QCD, as opposed to the more traditional route of just writing a check or making a donation to a charity.
Sure. So let's say, now the RMD age is 73, right? You're turning 73 this year. You had to take out $20,000 for your RMD, but you want to donate $2,000 of that to, your local food bank, right? So you contact whoever holds your IRA, you fill out a form, they send the $2,000 to the food bank, you get $1,800, therefore reducing your taxable income by $2,000, right? But there's a mistake that can happen with that, which I'm sure you're going to mention, right? As far as once that's done and being overlooked.
Yeah, so there is a really important order of operations when we're doing tax planning. We got to make sure that we have an intentional process to how we go about this, because you're mentioning both RMDs and QCDs. And so we want to make sure we get this in the right order, because what can happen, what I see go wrong sometimes, is that someone will say, hey, it's 2024, I've got to take this $20,000 RMD. Let me go ahead and take my $20,000 RMD. And then they have the charitable giving conversation separately, and they say, wait, actually, I want to make a $2,000 QCD. Now, we can't go back and say, wait, that RMD was actually meant for charity. I can't take that $20,000 I pulled out of my IRA and write a check out of my own savings account and count that as a QCD. We've got to make sure that these are done in the right order, or we just end up pulling more out than we'd originally intended to.
That's right. And then another big thing, too, is when you file, right, that you make sure you report that, because that's one of the ones I've seen overlooked. Because correct me if I'm wrong, but I think most custodians don't actually, when you get your 1099-R that says how much you got for your RMD, most of them don't actually report on there like how much went to the charity.
Yeah, so I guess a little bit in fairness to the custodians, the IRS has not created a way for them to report that.
Yeah.
And so basically the custodian has to report that money came out of your IRA. And then they have this whole list of codes they can assign to that distribution to say, why did the money come out? And the IRS has not given them a code that says, hey, a portion of this was a QCD. And so instead what they do is they check this little box on the 1099-R that says taxable amount not determined. And they just kind of leave it up to the taxpayer or the tax professional to figure out what that was. And so as a taxpayer, you want to make sure you're taking responsibility for giving the information that's needed to the tax professional, especially if that's you and you're DIYing it. We got to make sure that comes back up at tax time to say, oh, wait, of this $20,000 that came out of my IRA, $2,000 of it went directly to charity. And then we've got to make sure we report that, because before we were talking about line 5A and 5B for rollovers and how rollover gets kind of typed in the margin, what it looks like by a typewriter. The same thing will happen with QCDs on line 4. Line 4, in this example, line 4A would be $20,000 because $20,000 came out of the IRA. And then line 4B, which is the taxable amount, would only be $18,000 because $2,000 of it went directly to a charity. And then in the margin there next to the amount, we would say QCD, and that's really the only indication we would have of why there's a difference between those two numbers.
Yeah, that makes sense. And I've seen a lot of clients overlook that because they never told their accountant, hey, I made a QCD. And I guess the accountant didn't notice that box was checked. And then so they just reported the whole thing as taxable, even though it shouldn't have been.
Well, and so what's frustrating here, and this is the kind of the word of caution or the reminder for your listeners, is that it's not even, I mean, the tax preparer might have noticed, but that box can mean a lot of different things.
True.
It'll get checked for QCDs, but it'll get checked for backdoor Roth contributions. It'll get checked for rollovers sometimes. It'll get checked in all sorts of different situations where the custodian just doesn't have all of the information to be able to definitively say, here's how much was taxable. And so that box being checked on its own will not tell you, hey, this was a QCD.
True. There's another conversation, I guess, that needs to happen. Yeah.
Yeah.
Yeah. I mean, I got the idea actually from your brother, who's also a financial advisor, for those who don't know, of sending a little form every year to my clients' accountants showing like, hey, here's, the distributions, here's QCDs, a breakdown. And then as long as they give that to their accountant, they will clearly see, oh, I took a, $2,000 QCD. To hopefully report it properly. So we refer to that as a 1099 letter or year-end tax planning letter. And again, whether your listeners are DIYers and need to keep track of this information for themselves, or they're going to relay that information to a tax professional, this is information that's really integral to track during the year and then be able to summarize at the end, so that we make sure that we get the credit for the great tax planning that we're doing. Because I try to remind people all the time that tax planning only counts if it's reported to the IRS correctly. Sure. Yeah. Definitely. What about HSAs? Do you see some mistakes? Because I'm a big fan of HSAs. I preach everyone if qualify, making sure they're taking advantage of them. What mistakes do you see with those sometimes?
Yeah, a huge fan of HSAs as well. Use one personally. I definitely look for those opportunities for clients. A couple of things that come to mind. One is that I'll see people inadvertently get penalized for over-contributing to HSAs just because the form is confusing and they incorrectly fill it out. So what will happen, again, I'm going to nerd out just a little bit here. The HSA form on your tax return is the 8889. And on that form, there's a line, and forgive my nerdiness here. I'm pretty sure it's line 9. This is how much I look at this stuff. That says employer contributions. Now, unfortunately, what that actually means is payroll withholdings. And because it can be the employer or the employee portion. And so what will happen is that a taxpayer we'll just say $3,000 gets contributed to an HSA through their payroll. And they'll get to the tax return and they'll say, wait a second, I contributed $3,000 to my HSA. And so they'll put $3,000 of contributions. And then that payroll withholding also comes through. And now they're reporting that they contributed $6,000. And depending on the year, if they have single coverage, their contribution limit is around that $3,000 mark, maybe $3,300. And so now they've just told the IRS that they over contributed, and the IRS is going to penalize them for that. When in reality, it was just a misunderstanding of what those boxes meant. And so we got to make sure that similar to the QCD issue, the roller issue, that we understand what's getting reported. So that's a tax mistake that I see, more of a just how the account gets used. Not necessarily a mistake, but something we want to be intentional about.
Sure.
Is that one of the potential advantages of an HSA is that it can grow tax-free. And so a lot of times what I've found is that when people are first introduced to the idea of an HSA by their HR department, by their payroll department, it's almost explained to them more like a piggy bank of we just use this as we go, which if that's what your cash flow needs require, great. It's a great tool for that. But if we have the ability to pay for medical expenses from another source while we're funding the HSA, now all of a sudden, not only are we getting a tax deduction for putting the money in the HSA, and we can someday use it tax-free, the growth can be tax-free as well. And so depending on where we're at relative to retirement, this could grow for years or even decades and potentially be a very significant amount of money when we go to use it someday. And one of the nice things about the HSA, because the one piece of pushback I'll get from people is they'll say, well, I plan on being really healthy later in life, which hopefully I wish you all the best. We can't necessarily control that. And it's, well, what if I don't need that for medical expenses? And the great news is that the worst possible case scenario is that we are super healthy. We don't need it for medical expenses. And now it looks more like an IRA. We're not going to be penalized for it. We might have to pay tax, but there won't be penalties.
Yeah, I think that's at 65? You can just take it out without any penalties. You would just pay tax like an IRA.
Mm-hmm. Yep, absolutely.
Yeah. And then, I mean, we didn't get to this, but I'm sure you're, I've said it before, but you probably should track all your HSA eligible expenses going forward so that at any point you can reimburse yourself tax-free, right, for those out-of-pocket costs you paid for.
Yeah, absolutely. So it has to be for a year that you had an HSA or that you were eligible to contribute to one. We can't set up an HSA today and then go reimburse something that happened 20 years ago. Sure. But yeah, all along the way. So again, to this concern of what if I don't need that money later? Well, great. Keep track of your expenses as you go, and then you can request reimbursement from things that happened in the past.
I get people sometimes concerned that all right, I get audited by the IRS. How's this going to go if they see that I just took out $20,000 for my HSA? Any thoughts on that or any experience with somebody being audited that had this happen? Or
so I haven't personally worked with someone who got audited for those reimbursements, but I actually, somebody specific comes to mind who does HSAs all day long and deals with this issue on a regular basis. And this is a well-established area of the tax code, and so it's something. I mean, to your point. Keep receipts.
Yeah.
But I don't know of any horror stories where someone had their hospital bill from 10 years ago and the IRS is like, nah, never mind, that doesn't count. Right? This is something that was set up for a very specific reason. And as the tax code goes, this is pretty cut and dry. Now, don't keep the receipt for the horse that you bought that you wanted to call it an emotional support animal. Like that. Sure. That's a whole different thing. You're wading into very murky waters.
Yeah.
But your common medical expenses, keep the receipts. And if 5, 10, 15 years from now, you have a large HSA balance and you're not sure you're going to use it up on other things, or you just run into a cash flow need and that becomes an area of liquidity, great. Then ask for the reimbursement and move on.
Yeah, I agree. I mean, I recommend too keeping some Excel or Google Sheet file where as these things happen, if you can, you put them in there. So you also have a running total so that you could see, okay, I've now spent $15,000 on my HSA. If 5 years from now you want to go on a vacation, costs $15,000. Hey, why not? You could do it because you're reimbursing yourself, and even better, if your money's grown, now you're just spending your gains and your principal is still there earning interest for you. Yeah,
absolutely.
Yeah. So anything else you want to mention? Any other things you've come across this year just to kind of leave our listeners with?
Yeah, I'm just going to reinforce what we talked about at the top, which is seriously, all jokes aside, there are no patriotic awards for overpaying the IRS. You should pay every dollar you owe, but if you're intentional and you plan ahead, you can, over the long run, make sure that you're not getting killed on taxes. And so don't get hung up on how big of a refund did I get this year. Look at the long term and make sure that you're being proactive.
Yeah, I like that. I think echo that as far as long-term tax planning. Whether you're doing it with your CPA or with your advisor, you need to have a plan as far as what the next 3 to 5 years look like, maybe even longer, of what your income needs are going to be if you're retiring, and what can you do to, pull it from different areas and minimize the tax on that.
Absolutely.
Yeah. And, for those who are listening, Steven has written a book that you can see. You can't see it, but it's in his background. Just tell us about your book if anybody wants to check that out.
Yeah, it's called Don't Get Killed on Taxes. And it's the whole idea behind it is that we're all expected to pay taxes, but none of us are really ever taught what that means. And so it's meant for taxpayers to understand some of the more common kind of foundational concepts around how our tax code works, and then goes through different strategies that apply to a lot of people approaching or in retirement that can help reduce their tax bill. Awesome.
Yeah. And again, your podcast, Retirement Tax Services, people can check that out too. Any other, I'll put a link to that in the show notes. Any other contact information if people want to reach out to you?
I post a lot on LinkedIn. It's all tax related. It's super nerdy, but if that's your thing, it's a lot of fun. So.
Okay. Awesome. Yeah. I'll put a link to your LinkedIn profile too.
Perfect.
Yeah. Well, thanks for coming on this week, Steven. Really appreciate all the info. And, I wish you the best for this year and next year's tax season.
Thanks, Ryan. It was a pleasure being here.
Okay. All right. Thanks.